Keep the faith. It's a very strong economy. The economy, the basic economy, has reawakened, and it's going to stay there. I mean, I'm reading some of the weirdest stuff, how recession is around the corner. Nonsense. My personal view, our administration's view, recession is so far in the distance, I can't see it.
That was National Economic Council Director Larry Kudlow making it clear that the Trump White House is not worried about a possible recession, despite the volatility and the pullback in the stock market and some other signs. Joining me now, former CKE restaurant CEO Andy Pudster. He's also author of Capitalist Comeback, and Brandywine Global Portfolio Manager Jack McIntyre. Andy, let me start with you. Listen, I think there are a lot of people, particularly on Wall Street, who have been rooting against President Trump from day one, and for a variety of reasons. But he's not your typical conservative Republican. He's bringing ideas to the table that I think could hurt, their business models a little bit. And so I don't know that they're too quick on the draw always to say things like, well, there's a recession or we're not doing that great. It seems to me that we're doing pretty good right now.
I think we're doing very well right now. In fact, there's a lot of moving pieces here, and I'm sure Jack will talk about them. But the one thing that's driving the current level of economic growth, about 2/3 of it comes from consumer spending. And if you look at the 21 months under President Trump compared to the last 21 months under President Obama, weekly earnings are up about 40%. If you look at the last 9 months, they're up about 76%. People are taking home more of what they earn because the withholding rates came down in February. Every month since March, we've been up at least 0.4% in consumer spending. Those are very strong numbers. There's no reason that can't continue on. We've got 7 million job openings. When people start filling those jobs, we'll have even more consumer spending. So I think, Larry's part of the White House. He's got a political motivation, but I don't think he's wrong. I think we've got a very, very strong economy. We're at 3.3% GDP so far this year. And last November, these same Goldman economic experts were projecting we'd have 2.5% GDP growth for the year. So I think we're in good shape.
Last February, they told people that this market was not going to rally either. But there's been a lot of negative stuff. Here's the thing, Jack. Last week, Ralph Bostic from the Atlanta Fed, he gave a pretty interesting speech down in Spain. And he used a chart. And it's so interesting because it shows you where unemployment rates hit these lows. And not far soon after, we entered into recessions. So he was sort of suggesting, listen, we know that the idea is that the economy is doing so well that the Fed is the one that pushes us into recessions, and that's not going to happen this time. What do you make of all of this?
So I agree. The recession is not going to come from the Trump administration unless he really pushes against trade. But it's right. It's going to come from the Fed. It's going to come from the U.S. dollar if that continues to strengthen. Yeah, employment, it's a lagging indicator. So I would look to the initial jobless claims because and not just a little move higher, a sustainable move higher would increase the odds of a recession. But we're not in that camp. I think we're going to get a slowdown. I actually think for equity markets, a slowdown is actually going to be a net positive because it's going to get the Fed to maybe back off. I think the Fed tightening too aggressively is the biggest risk to the recession outlook right now.
What do you make of the inverted yield curve that sent the market spiraling a few times this year as we got closer and closer?
Yeah, so I think there's two messages to kind of take away from the yield curve. One is that, hey, growth is going to slow down. I'm not there yet. I'm more in the, hey, inflation is low. And it kind of goes back to, I hope the Fed actually listens to the message embedded in the yield curve. Inflation isn't out of hand. They don't have to tighten too aggressively. They've been tightening in December, it will be 3 years. Let's see the lag effect. And they're still going to be tightening through reducing the balance sheet. So, if I was advising Powell, I'd just say, hey, let's take a break.
Andy, yesterday we saw, for instance, Target get hit pretty good despite strong same-store sales and some other metrics, in part because they're investing a lot of money omni-channel. They want to be able people to pick up, to be able to deliver. And the reason I'm bringing this up is obviously an area of expertise for you, but there's a notion that the Fed may be stuck on a situation of inflation that we'll never get back to. Call it the Amazon effect or whatever you want. The way the economy is structured these days and the way businesses have to respond to the consumer, could we ever see the sort of runaway inflation we saw in 1974?
Well, look, anything's possible, but I think we do need to increase interest rates, but slowly. I think the Fed's got to have, an arrow in its quiver if we do go into a recession. But look, they've raised interest rates 7 times since the 2016 presidential election. They're going to raise it an 8th time in December. I'm almost 100% positive. During the entire Obama presidency up to the election in November of 2016, they raised interest rates once. You can't, if you're going to raise them 8 times in a 2-year period, that is going to have an impact on interest-bearing fixed income investments, and it's going to have an impact on equity. So they just need to slow down. Look, the economy's not out of control. Interest rates are not out of control. Inflation is not out of control. Just, go, if you're going to go more slowly.
All right, gentlemen, thank you both very much. Andy, Jack, really appreciate it. Happy Thanksgiving.